Hello. Today we're going to talk about inventory costing methods and how that affects the amounts that are in ending inventory and cost of goods sold. Okay, as we saw in the previous video, once an inventory is sold, the company moves the cost of the inventory out of the inventory account and puts it in cost of goods sold. Okay, now if every item that the merchandiser purchased costs $10, then that's real simple. If you sell 5 of them, you pull out $50 of cost. Unfortunately, in the real world, that doesn't happen. The purchase price of inventory changes. Okay? So we have these inventory cost methods to help companies know how much to take out of inventory and put into cost of goods sold. Remember, this is only used to determine how much goes in cost of goods sold. Does not affect purchases, does not affect anything on the front end. It only affects how much goes into cost of goods sold. There are 4 main methods listed here. The first one is specific identification. Okay, we're going to do the least amount of work on this because it is the simplest. Okay, it matches each inventory unit with its actual cost. This is used for inventory that has items that are unique and a way to determine which one was sold. The most obvious example is vehicles, because they each have a vehicle identification number. So when a car dealer sells this unit, they can look at their inventory and say, this is how much that vehicle cost, and pull that out. This can also be used for anything with a serial number or items that are very unique like jewelry. Okay, the other 3 methods are the ones we're going to focus on, and these are used for items that are more homogeneous, more like each other. Okay, so if we're selling shoes, okay, most shoes are going to be similar. Okay, they may be different colors, different sizes, but they're very similar, and we're not going to keep track of every single pair of shoes. Okay, so we're going to use one of these 3 methods. Okay, these are methods that make assumptions about which units were sold, even though that may not be the actual flow of the inventory items. Okay, so first in, first out assumes that the first units purchased are the first ones sold. So yes, you need to keep track of the purchases in order, in chronological order. Okay, last in, first out assumes that the last units purchased are the first ones sold. Really good examples of this in the textbook and in the PowerPoint. I'm not going to take time to go through all of the mechanics of this. I want you to understand why we do this. Okay? The weighted average cost, sometimes it's just called average cost, assumes that each unit's cost is equal to a weighted average of all of the items in inventory. To use a weighted average, okay, you're going to take the total dollars and in inventory and divide by the total units to get a cost per unit. Okay, this example in the PowerPoint's not great because the numbers don't line up. Okay, this is what I want you to see. Okay, comparison of cost of goods sold and ending inventory under 3 different cost flow assumptions: Fifo, Lifo, and weighted average. Okay, notice that the number of units across the top is the same. We had 1,000 total inventory items available for sale. So whatever we had in beginning inventory plus purchases gave us 1,000 total inventory items. We sold 800 of those. So we have 200 left in ending inventory. Okay, so the beginning inventory we have shown there, they had 100 units at $7. Then they purchased 300 units at $9 a piece, and then they purchased 600 units at $11 a piece. Okay, so multiply those all out. What we have in our inventory account is $10,000. That represents the 1,000 units. Okay, cost of goods sold using these methods. Okay, first in, first out, FIFO. The first units we have are assumed to be the first ones sold. So we start from the top. 100 units at $7, 300 units at $9, which gives us 400. We sold 800, so we have to take 400 of the second purchase at $11. Add those up. What goes into cost of goods sold? $7,800. From the 10,000, 2,200 left. Also, 200 units at $11. Okay. Second, Lifo, last in, first out. This one we start from the bottom. Okay, 800 units sold. We take the 600 at $11 and then 200 of the 300 at $9. That totals 8,400, gives us 1,600 left in ending inventory. Okay, the 100 at $9 and the 100 at $7. Weighted average. Okay, we have $10,000. We have 1,000 units. Okay, gives us $10 per unit. Times the 800 that we sold is 8,000. 200 left is 2,000. So as you can see, how much goes in cost of goods sold, which you know affects net income, and how much is left in ending inventory, which affects our total assets, is different depending on which method is used. Now, companies can choose whichever method they want to use, but once they do, they need to be consistent and use that same method year after year. Why? So that the year-by-year financial statements are comparable. Okay, now which method should companies use? Well, it's based on a lot of factors, and most of it is going to be management decision. Okay, the method that is used the most in the U.S. is FIFO. Okay, first in, first out. In times of rising costs, which most industries have, FIFO will give you the lowest cost of goods sold, which gives you the highest net income, and will also give you the highest ending inventory. Okay, so in times of rising costs, FIFO presents a better picture. Lifo is the opposite. Okay, Lifo is often used in industries where the costs are decreasing. Okay, technology is one such possibility. Okay, weighted average is used often when we have prices that are volatile, that go up and down a lot, because it smooths out the cost. Again, it's up to management to decide. Thank you.